Now that we've completed our primer and what a stock is, it's time to start learning about the basics of options. This is probably pretty exciting to you because that's why you're here, to learn about options trading. The very first thing we're going to study is a call option, and we'll learn all about that in this lecture. An options contract is a contract promising someone else economic rights on a stock at a future date. The way it works is someone pays money for a contract that says in the future they'll have certain economic rights on underlying stock. I know that sounds confusing now, but we'll dive into that as we go forward. But first we must realize there's two types of options, a call option and a put option. A call option is the right to buy a particular stock at some future date. And a put option is the right to sell some particular stock at a future date. First, we're going to dive into what a call option is, and then in a later lecture, we'll explore what a put option is. I'm going to oversimplify what a call options contract is, but 2 slides ago, we saw a buyer handing money to a seller and a seller returning a contract. So this is what that contract might look like, or a simplified version. The seller of the contract grants the buyer of the contract the right to buy 100 shares of a stock, and in this case, ACM. The buyer of the contract can execute this contract on or before March 14th, 2024 at a price of $100 a share. What that means is that any time the owner of this contract can cash it in, kind of like a coupon, I guess, and can buy 100 shares of the stock ACM for $100 a share. Doesn't matter what price ACM is trading for in the public market, the owner of this contract has the right to buy 100 shares for $100 a share on or before March 14th, 2024. If the buyer does not choose to exercise their right to buy 100 shares of ACM on or before March 14th, 2024, the contract expires worthless, and there'll be no refund given to the buyer. So remember, the buyer took money from their bank account and paid someone for this contract. And if they don't use this contract expires worthless. And finally, the consideration. As I mentioned, the buyer pays money to the seller. This is the reason the seller is willing to do this. This is the reason the seller is willing to take the risk to issue this contract, is they want to receive something called premium. This is the money they receive from the seller in order to have this contract. So in this case, the seller paid $1 per share, or $100, due immediately when they bought this contract. For example, it might be February 1st. The buyer of this contract might have given the seller $1 per share for this contract on February 1st with an expiration date of March 14th, 2024. So the seller of this contract is going to bet that the ACM is not over $100 a share on March 14th. And the buyer of this contract is making a bet that ACM will be above $100 on March 14th, 2024. The seller is hoping to collect that premium and have the contract expire worthless. The buyer is hoping the ACM goes up in value, so the value of this contract becomes much, much more. And we'll explore the mechanics of that in further slides. Now that we have a general overview of how an options contract works, let's learn some terminology. First of all, as we mentioned, there's 2 types of options contract, at least in the United States, a put and a call contract. One is the right to sell shares and one is the right to buy shares. Every contract has an expiration date, and that's the date that the contract either needs to be executed by or it expires worthless. The strike price is the price within the contract that specifies the amount of money you pay to buy or sell shares. So in the case of a call option, you're buying shares. In the case of a put option, you're selling shares. This is a fixed amount that's determined at the time that you buy the contract. The underlying stock is the stock that the options contract references. That's why when we started this course, we took time to learn about how stocks move and the basic fundamentals of a stock. The core foundation of options contracts is the stock and the movement that that stock makes while owning that contract. The writer of the contract is the seller of the contract, the person that gives the contract in exchange for money. So oftentimes you'll hear the term, they sold the options contract or they wrote an options contract. That's what that means. The money you paid to open an options contract is called the premium you paid. So once again, remember, the seller is hoping that the options contract expires worthless. The buyer hopes that the stock moves enough that the options becomes worth something. So it's kind of like an insurance premium. You pay money to your insurance company every month, and if your car gets in an accident, they fix your car. However, the insurance company is betting that you never get into an accident, and they get to keep that premium. If the car gets in an accident, of course, they have to pay out much more than they received in premiums. So that's kind of the same concept with options. So that's why the price that you pay to own an options contract is called the premium. It's the money the seller receives for taking on the risk of writing the options contract. And I think I combined both these terms into my last statement. The premium paid and the premium received is the money that goes from the buyer to the seller for taking the risk. Now that we know some terminology, let's revisit our original image, where we have the buyer handing cash to the person with the contract. The writer is the seller of the options contract, the person giving the contract to the buyer. The seller takes on unlimited risk when selling a call option. The buyer is the person giving money to the seller, the writer of the contract. The buyer pays a premium and takes limited risk, the premium they paid, for unlimited upside in the case of a call options contract. We're going to learn a lot more about that going forward, but these are basic terminology and the basic transaction of how options contracts work. Now, one side note, this is all managed through your broker. You're not actually writing out contracts and signing and handing cash back and forth. I'm just using the contract as an illustration. When you buy an options contract, the actual contract or the mechanism of exchanging money and everything is all handled via your broker. So you're not actually sitting at a table and exchanging money and signing pieces of paper. But that's the best way to visualize this. The brokers and exchanges will enforce these contracts on your behalf. So you don't really need to go after someone for the shares or anything like that. It's all handled automatically through your broker. But the best way to visualize this is a contract and money exchange. Just want to be a little clear on that. And we'll learn more about how to buy these and sell options contracts later on in this course. We will see and actually buy some options contracts with our online broker at the end of this lecture. And just to drive home the concept a little bit further, because this terminology is used over and over and over again throughout this course, so I want to repeat myself a bit. So I want to go back to our generic options contract that we talked about. Now that we have some terminology, we can match up the details of the contract with our terminology. First of all, we mentioned ACM, our pretend company, Acme Inc. That refers to as the underlying stock. This options contract only references ACM. You can't change this contract to have some other stock or anything. It's only ACM. Next, we mentioned March 14th, 2024. That's the expiration date. That's the date that this contract must be executed by or it expires. If it expires, the seller of the contract keeps the premium and nothing else happens. It expires worthless. If the buyer executes it, the seller has to deliver the shares promised in the contract. Next is the strike price. This is the price that you can buy shares for. So this contract is saying that you can buy 100 shares of ACM by March 14th for $100. And this is referred to as the strike price, the price that you can buy the shares. And lastly, we have premium. This is the amount of money that you pay to the seller. So in this case, it's $100 a share. And since the contract references 100 shares, they would have to pay $100 due immediately to have this contract. And once again, the broker would manage that transaction for you when you buy the contract. Due immediately means you bought the contract via your broker. I want to do a quick side note and say most contracts in the United States are 100 shares. You can't just buy a 10 share or a 5 share options contract on the open market typically. All options contracts are 100 shares. There are some occasions where the options contracts will be less than 100 shares, but those are usually exceptions. A good example is if there's a stock split or something. If there's a stock split, they might have to modify the contracts to deal with the stock split. But for the most part, throughout this course, we'll always assume an options contract is 100 shares. And when we talk about the pricing of the options contract, we always do pricing for 1 share. So if an options contract is selling for $1, it means you actually have to buy it for $100 because it means $1 per share. So just wanted to make that clear that 100 shares per options contract. Let's look at a profit and loss chart for a call option at expiration. This is what the profit and loss might be if you own the call options contract at expiration. Here on the x-axis, we have different closing prices for our ACM stock on March 14th, 2024. We don't really know what the closing price of ACM will be on March 14th, so what we're doing is projecting and learning about the different scenarios based on what the ACM might be on March 14th. In this case, the strike price, our price that we can buy shares for, is $100, and we paid $1 per share. So we actually paid $100 to own this call option. So this call option is considered in the money if ACM is above $100. So remember, this call option gives us the right to buy 100 shares at $100. So if ACM is trading at $110, we could force the seller of the options contract to sell us 100 shares at $100, and then we would own 100 shares that we paid $100 for, but the real value is the $110. So we could almost turn around and sell those shares on the open market and make a $10 per share profit. So whenever ACM is above $100, we call that being in the money. That's when the call option starts to be worth something. Because let's look at the other way, when it's out of the money. Let's say ACM is down here at $90. Well, why would we exercise our call option at $100 if we could buy 100 shares of ACM for $90 in the open market? Why would we pay $10 more per share by executing our options contract when we could just go to the open market and buy it for $90? So the call option becomes more or less worthless if ACM is below $100. So in that case, we take our max loss of $100 because that's what we paid to buy this. Remember, $1 times 100, because there's 100 shares per options contract. So we paid $100 to own this options contract. ACM ended up being down here around $90. So there's no advantage for us to execute this options contract. So we just lose that premium that we paid on March 14th, 2024. So we took a bet, we lost $100, and the seller of the options contract got to keep that $100, and the options contract expires worthless. As we've already learned, if ACM is at, say, $110, this options contract becomes very profitable. However, there is a break-even point right here. Because we paid that original $100 to open this contract, we don't get that $100 back. That $100 stays with the seller of this contract. So we actually move our break-even up to $101. So we take the strike price plus the price we paid would be our break-even. This options contract is not really worth anything until ACM gets above $101 because we have to offset our original premium paid before this trade becomes profitable for us. And as you can see here, there's kind of a declining max loss if ACM closes somewhere between $100 and $101. Say this thing closes at 150 cents, we might take a $50 loss instead of a $100 loss because there's still some value in here to exercise the options contract and recoup some of our premium. But we don't actually make a profit until it gets above $101. And one last thing about just owning an options contract is there's unlimited profit. You know, if ACM went to $500, the seller of the options contract would still have to sell us 100 shares at $100. And so if it was up here at $500, we would pay $100 for those shares, and then we could turn around and sell them on the open market for $500, and that would be an immediate profit of $400 a share, minus the premium we paid to buy the contract. Let's go over the math one more time. I hate to repeat myself, but it's so important to learn these things. So I want to show you visually, and then I want to show you in writing, and keep repeating these concepts over and over again so you fully understand them. Let's say you're bullish on Acme Inc., ACM. You can either buy the stock directly, or maybe you could buy a call. They both have the same economic upside. You believe the stock will rise in value over time. So let's look at the math of the difference between buying a call and buying the stock directly. Let's say ACM is currently trading at $100, and we want to buy 100 shares of ACM. That would cost you $10,000. So you would have to take $10,000 out of your brokerage account, go on the open market, and buy 100 shares for $100. And at this point, you would not have $10,000, but you would have 100 shares of ACM. You would consider yourself a shareholder, or you would own stock in ACM. And your broker would hold that in your account for you. Now let's say ACM rises to $105 on March 14th, 2024. We're assuming up here we bought this maybe in February sometime. You would have a profit of $5. You bought the stock for $100, and now it's worth $105. So the difference is the profit you would have. Or this would be a $500 profit because you actually bought 100 shares. This would be considered a 5% return. You invested $10,000, got $500 back. That's a 5% return. Now let's compare the economics of purchasing one call option instead of purchasing 100 shares. Because call options represent 100 shares, you're still controlling 100 shares of ACM stock. So you still have the same economic interest as if you bought 100 shares directly. Let's assume you use the strike price of $100, which is where the stock is currently trading, and you choose an expiration date of March 14th, 2024. And you paid $1 for these shares, or $100. So $100 left your account to get a call option with a strike price of $100. So now for only $100, you control the same 100 shares of ACM that you would have controlled had you just bought the shares in the open market. Now let's assume ACM rises to $105 on March 14th, 2024. Our options contract would be worth $500 because we have the right to buy 100 shares of ACM for $100 because the strike price was $100. On March 14th, we could have executed our call option and purchased 100 shares for $100. But the open market, ACM was trading for $105. So once again, we could have just immediately turned around and sold those shares on the open market and made $5 a share. So using that scenario, that'd be an instant profit of $500. We almost have the same outcome because we received a $500 profit from our call option, and we received a $500 profit from owning the shares. The difference is we only spent $100 to buy the call option, and we spent $10,000 to buy the shares directly. The return on investment here is almost 400%, much different from the 5% we received from owning the shares directly. We have to consider one more thing. We paid $100 for the call options contract, so we have to factor that into our total profit. The seller of the options contract keeps that $100 no matter what, or $1 a share. So our total profit is actually $400 because we have to subtract out the $100 that we paid. So we received $500 profit from selling the shares and executing the contract on March 14th. But we had to subtract out the $100 that we already paid. So our total profit is $400, not $500. Still an amazing return relative to the 5% return we received by just buying the shares. I went over some of this, but I'll go over it one more time. So once again, if you just bought the shares directly in our scenario, you got a 5% return. While if you bought an options contract, you got a 400% return. As you can see, call options contracts give you major leverage relative to stock trading. You can spend $100 to get the same outcome as you would for $10,000, for example. But there's one caveat. Options are way more complex. With call options, you need to be correct about the future direction of the stock, and you also need to be correct on the timing. Remember, options contracts expire. So say ACM is going to go up in value, but it needs to go up in value by the expiration date. So anything can happen in the stock market. There can be anything random that causes the stock not to go up as you would expect. The overall market can just hold stocks down. There could be management change. There could be bad news from the company. Anything could cause the company not to increase in value at the same rate that you expect. So with options contracts, you need to be very precise on your timing, or the options contract will expire worthless and you'll just lose your money. Overall, you might have been correct on direction. If you were wrong on timing, you still would have a loss. This is opposite to owning the stocks directly. When you own a stock directly, you can sit on the stock forever and just wait for your timing to be correct. So like most things in life, you get a better return, but you also take on a lot more risk. So owning stock directly is a far more conservative approach to investing in a company, but you get a far less return relative to owning call options. As I just mentioned, the main complexity is making sure that the direction of the stock matches before expiration. That's a key concept when trading options. The expiration is your friend and is also your worst enemy when trading options contracts. And we'll learn a lot more about how expiration is your friend when we start getting into selling options. When you're a seller of an option, the expiration date is your friend. You're really hoping that the stock does not move against you before the expiration. So sellers of options contracts typically have a tight expiration because they're hoping that the options contract will expire before the options contract becomes in the money and turns against them. We have some increased complexity because a call option will have to increase more than a stock in order to become profitable because you have that premium you paid. So in the case of ACM, in the example we've been going over, if it only increased by 50 cents, if we own the stock, we would have a profit. But if we own the options contract, we would actually have a 50% loss because the break even needs to take into consider the premium paid to own that call option. Let's go over the math one last time, but in a more condensed, simplified version. When purchasing 100 shares, we pay $100 times 100 for $10,000. $10,000 would leave our bank account. And then sometime in the future, the price of the stock appreciates to $105. Now we can close this trade. So we take $105 times 100, and we would receive $10,500. So the difference between these two is the profit, $500. This would be a 5% return. Now what's interesting about this is our max loss would be $10,000. This stock could go to zero. The company could go bankrupt, something can happen, and this company could just go to zero. So our max loss is that $10,000 that we originally invested. But we also have unlimited profits. The price of the stock could go from 100 to 200 to 300 to 500 to 1,000 to whatever. So by owning the shares, we have unlimited upside, unlimited profit. And lastly, relative to options trading, we have unlimited time. We can hold those shares forever and just wait for the stock to increase to our profit target. So there's no hurry, there's no expiration, there's no stress to make the trade work. We can just sit on it until the trade works. So owning shares of a company has the advantage of giving you unlimited time. Meanwhile, if that stock has a dividend, you'll be collecting those dividend payments while you wait for the stock to go up. Options have no dividends whatsoever. So that's another advantage of owning shares versus options. Now let's go over the economics one more time of buying just one call option on ACM. We pay $100 a share, so times 100, because call option's 100 units, 100 shares. So we would pay $100. $100 leaves our bank account and buys this options contract. And then sometime in the future, before our expiration, let's say ACM goes to $105, like it did over here. Now our call option would be worth $5, the intrinsic value. The difference between our strike price and what it's currently trading at would be $5, the intrinsic value of this option. Now times 100 shares, our options contract is worth $500. So to figure out the profit, we paid $100 for the options contract. It's now worth $500, so our profit is $400. That's a 400% return. 400% return relative to the 5% return that we received from the stock. But what's also interesting here is our max loss is only $100. Our max loss is what we originally paid, right here, what we originally paid to open this call option. So that's really neat. So we only paid $100 versus the $10,000 max loss of owning the shares. And we also share the same thing with max profit. We have unlimited max profit. As ACM goes up, our economic interest continues to grow. So if ACM goes to, say, 110, the option would be worth $10 a share, and we'd have an even bigger return. The max profit is unlimited, just like owning shares directly. And now for the one bummer about call options is the expiration, the time to profit. So in our example above, the example we've been going over, March 14th, 2024 is when this option expires. And as we've learned, ACM needs to be trading above $101, the strike price plus the premium we paid, or we lose money. The real bummer about call options is the expiration. And so you have to be right about your timing and direction when using call options. Now let's go over the math one more time in the situation of a loss. What happens if ACM does not go up in value? Let's say ACM drops to $95. So remember, we bought it for $100, so we spent $10,000 when comparing it to buying the stock directly. Now, if we close this trade, it's down to $95. We can only close it for $9,500. So the profit on this would be a loss of $500. Relative to purchasing a call option where we paid our original $100, and because ACM was not above the $100 strike price, this call option expires worthless. The seller of the options contract gets to keep our $100, and we lose the $100. So in the case of ACM going from the price of $100 when we bought the call option to $95 at the time of expiration, we would lose $100, the premium that we paid. As you can see, when you're wrong about direction, buying call options really reduces the downside potential. We only lost $100 relative to the $500 that you would lose if you own the shares. As I mentioned before, sometimes you can buy stock in an amazing company with amazing fundamentals, but the market just forces the stock to go down. They say that 50% of any stock move is relative to the overall market. So the company might be doing fantastic, but the overall market will just bring down a stock. So during COVID, for example, Amazon and Netflix were doing great because everyone was staying home and having stuff shipped to them, and they were watching Netflix. But in the beginning days of COVID, the overall market still brought those stocks down because of the complete uncertainty. So people were just selling everything, bringing all stocks down. While the fundamentals of those companies were sound, the stock price still went down. That's why sometimes owning shares relative to a call option gives you more time for your thesis to play out, because you're not fighting up against the expiration date of a call option. I really hope by repeating myself over and over again, I've really driven home the mechanics of how a call option works, and I hope you're starting to realize the difference between owning shares and buying a call option directly. But that might bring up the question of when is it best to buy call options versus when is it best to buy stock in a company directly? Typically, you can buy a call option when you think the price of the stock is going to go up in a relatively short period of time, meaning it's going to go up before the option expires. You're bullish, and you're kind of quickly bullish. You're so bullish that you think the stock is going to go up before the expiration. A good example is you think a company is going to come out with good earnings. Publicly traded companies have to announce their earnings every quarter. So you might buy a call option ahead of the earnings. And when the earnings comes out, typically a stock might move based on the results of those earnings. And when the stock moves, and if it moves in the right direction, you'll have a leveraged return when you buy a call option. And because this is a timed event, you know the event is going to happen when the company announces earnings. You can use the leverage of a call option to get a better return. So that's just one example. And we'll learn more about earnings trades and stuff in future lectures. But just wanted to give you some ideas that you can use call options when you think there's a time-sensitive event that might move the stock. Sometimes people buy call options when they want to limit their risk. Say you just want to take a bet, kind of like a casino bet. You think a stock is going to go up in value, and like we saw before, you can own 100 shares for $100 versus owning 100 shares for $10,000. So sometimes people will have strategies where they make lots of little bets, and they assume some of them will go against them. But when they do go in their favor, it's a big return. It's almost like the venture capital model. Venture capitalists make a lot of small bets in companies, And only a few of those companies really take off and go public. And the big companies that go big will pay back all the losses of all their bets that didn't work. So sometimes people will trade options that way, using a limited capital, allowing them to make a lot of bets across the board. Now, I don't encourage this, but there are some traders that like to go big or go home. Think about that crazy guy at the casino that's just making big bets over and over again. People of that excitement that make bets that have big returns might like options trading. I call this the go big or go home trading style. It's not really for me. It's not really what we'll focus on in this course, but that's one use case for call options in the market. Now, this might not apply to us as small retail investors, but if you want to make big trades, meaning you want to buy a lot of shares, you might end up moving the market. If you're just buying a lot of shares in the open market, well, naturally, through supply and demand, the price of the stock is going to go up. So if you want to own more shares or control more shares, you might buy options instead of buying stock directly. And then later on, you can exercise your options to get that shares. So this is a game that big hedge funds might play. But if you're trading more illiquid stocks or something, this might be relevant to you. You don't want to move the market just to get the number of shares that you want for your portfolio allocation. So just something to consider. So one thing that we haven't talked about yet is multi-leg options trades. A multi-leg options trade is when we buy more than one options of different strikes or expirations or whatever in a combination to build an overall trade. So we might buy call options as a component to a multi-leg options trade. I'll teach you all about this in future lectures because that's a key component of building long-term strategy is using multi-leg options to build your strategy. I just want to get that in your head now that just buying naked call options and hoping the stock goes up or down isn't necessarily a strategy that we really talk a lot about in this course. Buying one option is just a component of a multi-leg option strategy, which is what we really promote throughout this course. Now we'll go in much greater detail about the covered call trade in future lectures. I want to give you a little primer of how covered calls work. When you write or sell a call option, you are taking the risk that at expiration, you have to sell shares to the owner of the options contract at the strike price. Now, if you don't own those shares, your broker will go in the open market and buy those shares for you. And then they will deliver them to the owner of the options contract. As a result, the broker will not let you write or sell an options contract unless you have the cash in your account to cover buying those shares in the future. This is called a margin requirement. The broker requires you to keep that cash on the sidelines so when the options expires, they can use that cash to go in the open market and buy the shares and then deliver them to the owner of the options contract. Of course, if the options contract expires worthless, the margin requirement is removed and then the cash in your account goes back into your balance that you can use for any future trades. For example, if the strike price is $100 and the current price of the stock is $105, your broker will buy 100 shares at $105 and then sell them to the options owner for $100. You'll lose $5 in that trade. A covered call trade is when you already own 100 shares of the options contract that you wrote. In this case, your broker will not require you to have any additional cash on hand, no additional margin in your account. It just won't let you sell those shares until the outstanding options contract expires worthless or expires. So what they'll do is they'll take the 100 shares that you have in your account and set them aside so you can't do anything with them. You still own them, you still get the dividends on them, but you just can't sell them because you have this call option that you wrote that blocks you from selling them. Because if the owner of that call option ever executes the call option, you'll have to take those 100 shares from your account and deliver them to the owner of the call option. Once again, in the covered call situation, if the current market price is above the strike price at expiration, you will have to deliver shares to the owner of that call option. Let's look at the economics of that. Let's say you have 100 shares of stock that you purchased for $50 and the current price of the stock is $95. You then write a call option with a strike price of $100. So in this situation, you're hoping that the stock does not go above $100. You hope it stays at 95 below or somewhere between 95 and 100. In that case, the premium that you collected, you'll get to keep. It'll expire worthless. Now, if the stock rises above $100, the strike price, you are obligated to sell those shares to the options owner for $100. But this is kind of cool. It's a risk-free transaction. Your profit will be the $100 strike price, which you were forced to sell the shares, minus the $50, the price you originally purchased the shares for. So you bought it a year ago for $50, plus the premium received. So in this case, you have $100 minus the original $50 basis. So you just made a $50 profit, but you also brought in the premium you received. And that's the basic mechanics of a covered call. You tend to want to sell covered calls when you already have a pretty healthy profit. You just want to collect premium until maybe those shares are called against you and you have to deliver them to the owner of the options contract. I consider this sort of a forcing function. Let's say you have shares that you've held on for years and you're just not sure when to sell them. You've already gotten a pretty good profit on them and you don't really have a reason to sell them, but you also think it's run up a lot. In Wall Street, we have the saying that bulls make money, bears make money, and hogs get slaughtered. So if you have a stock that's really run up a lot, you've already have a massive profit, you don't want to get slaughtered by being greedy, hoping to get more and more out of that one stock. Through what I call a forcing function with covered calls, you continue to receive premium on your shares by selling the covered call against the shares that you already own. And if the market moves against you and you have to deliver the shares you own to the owner of the call option, well, that's a forcing function to make you sell the shares that you already have a great profit in. So the idea is maybe you continue to collect premium on those shares until one day the market moves up too much and you have to give up your shares. But it becomes a risk-free trade, which is kind of neat. And once again, a lot more in covered calls in later lectures. We'll look into how covered calls can be used to build a strategy that you deploy over time. When do you write call options? Well, one scenario is when you're simply bearish. If you think a stock is going to go down in value, you could sell call options that are out of the money. You keep the premium, and if the stock goes down in value, the options expire worthless, and you have the premium. But what's also cool about this is if the stock just stays flat, you still keep that premium as long as your strike price is above the current market value. So if you're neutral to bearish, selling call options can be a great strategy. Another time to sell call options, which we just talked about, is if you already own the stock and you can earn premium while you wait for the forcing function to just force you to sell the shares. And lastly, something I've already hinted at, is combining options together into multi-leg options trades would be a time when you could sell call options. So selling the call option might be offset by buying some other option. We'll learn a lot more about this in future lectures.